Oh, awesome. Hello, everyone. Um, Thanks, Adrienne, for having me and Cameron on today, and for Bar Elusive, who has organized this for 2 years now behind the scenes. And this is just going to be a talk about crypto and taxes. I was lucky enough to do this last year with Cameron around the same time, I think, where we met for the first time, and we were just spitballing, and I threw him all of my hypothetical crypto questions at him, and I couldn't have been more impressed. And I'll just say, last year when we had this conversation, it was still like very much bear market vibes. Like there wasn't a ton of token trading happening. Like meme coins were not popping off. I think we were talking a little bit about airdrops. Maybe it was Optimism's airdrop or the
Yeah.
DGen airdrop. So that was just starting. But I feel like we find ourselves in a totally different version of crypto in 2025 here, both with meme coins and DeFi, and token prices have gone up. And then also maybe we're entering a new regulatory environment, which is something to consider as well. So I maybe would just kick this off right off the start and say, like, do you think the new U.S. administration, and I guess I should clarify that we're talking about U.S. crypto tax policy.
Yeah. Yeah, given the accent,
And
yes. Well, we were speaking American U.S. tax policy,
yeah,
yes.
and Cameron, I guess like I'll just introduce myself very quickly. I'm Chris Carella, C. Carella on Farcaster, founder of the Scout Game. I'm a Noun. I'm in the Optimum Citizens House. All those things. Founder of Purple, a public goods DAO for Farcaster. And Cameron, maybe you can give yourself a brief introduction to yourself before we really just dive right in.
Yeah, we'll keep it tight. My name's Cameron. I'm a CPA, tax practitioner and partner here at Darien Advisors. I've been working in the Web3 cryptocurrency space as a tax practitioner since 2017. Through this whole, through Darien Advisors since 2021. So managing on-chain compliance, transactional work, planning, navigating, hyperliquid, airdrops, all the fun stuff has been our cup of tea, and very excited for today's conversation.
Awesome. And then, like, who are your clients? Are they foundations, or are they individuals or small companies?
Yeah, I would say our north is just on this industry itself. So anybody that has exposure to Web3, digital assets, cryptocurrency, which can range from contributors. So we work with a lot of like small business, freelancers, whatnot. We do a lot of work with foundations, startups, high net worth individuals, investors. Basically, if it's an aspect of your portfolio, we're open to a conversation as long as it's the right vibe and fit.
All right, awesome. What I loved about the discussion last year was you would tell me how you are viewing the world, but then also in some cases like an alternate view, or maybe how the IRS may be viewing the world.
Yeah,
And so
exactly.
yeah, so I just want to think about, like, has your worldview changed since the election, since the executive orders that have happened? Like, has anything legally changed, first of all, on tax policy? I guess we're talking about your 2024 taxes,
Yeah.
and then just generally, has your opinion changed on anything?
Yeah, I would say nothing as far as like the actual how we do taxes this year for the 2024 has changed. So no law came into place, no policy affecting the 2024 tax year. So business as usual, apart from all the crazy upgrades and activities on chain. However, most of the stuff has been prospective. So starting this year, there's been a lot of stuff, a lot of FUD around crypto Twitter, crypto Farcast is on like the basically wallet by wallet tracking. So revenue procedure 2024-28. This is actually our first like real hard law impacting crypto and digital asset reporting in the states, where now for custodial, basically for custodial assets, so at exchanges, we're tracking this by wallet, and also too for self-custody wallets, we're treating this by wallet. So what that means is when you're actually selling transactions, or sorry, selling assets, if that ETH is within this wallet, like the one signing the transactions, the one essentially the basket, where before you could say, actually, I'm going to sell this ETH located in my Coinbase account or my Kraken account on a portfolio basis. So it's more just kind of like tracking various lots within the various locations. But there's still some stuff that's open to determination of what's a wallet. Is it actually like the address level, or is it the seed? Is it the front end, etc. So more to come. And the other stuff too affecting this year and going forward is the brokerage reporting, which doesn't usually affect a lot of investors. It's mostly on the protocol, the startup, the broker dealers, where if you custody or manage funds for folks, there are additional reporting requirements here this year. But thankfully, that's all 2025's problem. Although we're here, but we're looking retrospectively for tax considerations.
All right, awesome. I'm going to ask you questions as like a citizen of being on chain, so mostly from an individual.
Yeah.
Uh, to start like just to set the baseline and start with the simplest question. Like, say I did some work this year. I was paid in ETH. It was hybrid DAO. I was paid in ETH. Like, how should I even think about that from a tax liability perspective?
Yeah. So the IRS views cryptocurrency as property, and the earning or receipt of property is taxable at the fair market value at the time of receipt. So if someone sent you one ETH is around $3,100. You've now recognized $3,100 of income. If you are a sole proprietor, a freelancer, there's also federal, state, as well as potentially self-employment tax associated with that transaction. But at the very least, we've got an income tax event. And then say tomorrow you turn around and sell that one ETH for 3,500. You've now recognized ordinary income of 31 and then capital gains of 400 to make up that difference. So there's been potentially two tax events, the receipt and the ultimate liquidation of that asset.
And if the liquidation is lower than what when you received it, that's just some kind of how do I think about
that? As my mom would say it, tough shit, Sherlock. In the case of the unfortunate part is that ordinary income, capital losses can't offset it. So it's something where it's the kind of inherent danger or risk with transacting in cryptocurrency is that you could accept that ETH at 3,100. Tomorrow price could drop to 25, but you can't offset that loss against the ordinary income. So it's very important as a strategy for those that are earning on chain, whether they're contributing, consulting, just even doing yield farming DeFi, is essentially locking away a portion for tax reserves, because there's an inherent like shoulda, coulda, woulda of like, I've got the asset, it's depreciated, I can't even sell it to pay the taxes, let alone offset that original income, which something we saw a lot, when the bull was starting to subside in 21 to 2022. We had a lot of clients in Seoul, they recognized income at 180, 190. It was certainly not that there the first week of January, nor let alone April 15th. So very important and good financial housekeeping to at least think about that and plan for that future upcoming tax bill.
Yeah.
Cameron, follow-up question. In this hypothetical, Chris gets paid by his DAO or wherever. He gets ETH. He sells it or converts it to USDC, buys it back at ETH right away, and then it depreciates. Can you then take a capital gains or a loss from that? Or am I, and I don't know if it's
No,
that question, but that's kind of, if does that protect you from the downside?
Well, I would say, so kind of like walking through it is, if you swap a portion USDC, like, hey, like my effective tax rate's 25%, 35, 40% if you're in New York or California. You swap that portion into USDC and kind of lock it away, then yeah, you're kind of like free and clear in-house money. And it kind of like covers the tax obligation. But it still opens you up to, if you rebuy that ETH, it still depreciates. You've got a capital loss, but at the very least, you've got some, a tax reserve or cash flow planning for it. So it is good, like a good practice. I like to say, like a rule of thumb is 25%, 20%, depending on where you're based of, just safeguard in USDC. Heck, if you're earning like a protocol, token, project token, swap it back to ETH and lock in at least that principal, because there is a lot of volatility in the market, as you can all imagine.
Is you basically are recognizing this as just like revenue, like any, like whether I'm a contractor and I get paid in USD or I get paid in ETH, that's being treated the same way. If I'm selling an NFT, like, is that similar? That I think of that as like as revenue, like if I was selling a product, or is there a different accounting around it?
No, in the case of selling NFTs, so if you are like the original, like say you have a deployer wallet, you've launched a smart contract, you're in control of the NFT, that actual minting or selling to the public is similar to like doing consultancy, contributing, taxable as ordinary income at the time of receipt. But if you like bought an NFT, sold an NFT, that's just all capital gains, which is similar to trading and swapping other fungibles or just other digital assets and cryptocurrencies. I did see something about this past week that there's been signaling, at least from the SEC, to treat NFTs and potentially meme coins as collectibles, which means they could be beneficial of different, basically property treatment, and not just kind of like general property like houses, but it could be eligible for Section 1031 exchanges, differential tax rates at the collectible level, and not be treated as just regular old property. So there are some things that are being signaled by the administration, but still TBD.
Got it. And then if I received like a grant, maybe it was like retro funding for work I did, or a proactive grant, as like a, to me individually, how do I think about that?
Yeah, if a project just sends you like, hey, here's 50 grand USDC, go build something. How the IRS views that is because it's been transferred to you and you've received all rights of it, then it is income. If there's like a fulfillment clause, a refund clause, like, hey, if we don't complete phase 2 of this development schedule, it'd be refunded. In that case, you could argue that all of it is taxable at once underneath accrual-based accounting. But if it's essentially received free and clear with no obligation return and it's yours, it's going to be treated as income.
Is there any like amount that you get that is just not even worth thinking about? Like, imagine I'm on Farcaster, I'm participating in rounds, I put up some art, I earn like 0.01 ETH or 0.001 ETH. Like what could, yeah, should I write that down in my ledger, or is there some amount where it just doesn't matter?
There's a concept of materiality. So even for us, like when we do our reporting, we're not doing 100% accuracy. We're doing it to a degree of confidence, whether it's 95, 97, depends on the ultimate transactions. But I'm not going to go through and verify that every single, fraction of an ETH transaction is correct. But we're going to focus on the big ones. So we've had in cases for clients that are like, dabbling, or hey, I was off last year, they got a few sales, fantastic, we don't need to report, or maybe just check the box. But if there is, it all depends on the activity. A couple $100, IRS isn't going to sweat. A couple $100,000, different theme altogether.
Yeah, cool, got it, awesome. My next progression here is like maybe someone's putting into crypto or they're hanging around Warpcast, and to nothing but their normal average actions, they have received an airdrop. I think Adrienne, probably when you joined Farcaster, probably experienced this pretty early on.
That's right.
So
you're talking about me, Chris.
Yeah. So first of all, it's like I was notified that I have been awarded an airdrop. I went to the website. I see how much I can claim, and what if I don't claim it? And then obviously, what's the difference once I do claim it?
Yeah. So we're getting kind of the concept of actual versus constructive receipt. So we're extrapolating from what the IRS has determined for other types of assets or with the receipt. So in the case of like, let's imagine it's not ETH, but let's say it's $100, right? So I put a Benjamin right on the table, and it's there. It's been essentially constructive receipt. It's made available to you, but you're not taking it off the table. When you take it off the table and put it in your pocket, that's actual receipt. So the IRS views that constructive receipt is technically taxable. So in the case it's been made available to you, it's claimable, it's therefore taxable. Now, that smart contract or that front end isn't controlled by you. So we would view that once you actually claim it and take that NFT, that airdrop or whatever it is into your wallet, and therefore you can sell it, exchange it, send it to friends, etc. At that point in time, it's been claimed, and therefore it's income. So that's how we typically view it. But the IRS, in the case of an audit or review, could determine, hey, it's when it's been accrued to you, made available to you, and therefore it's taxable. But most tax softwares will defer upon when it's actually claimed and into a wallet under your dominion and control.
And then you're saying that that's revenue at its like current value.
Exactly.
Claiming, even though like 10 seconds later it could be half that value.
Right. And it's something where we're kind of getting the concept of like what is the fair market value of it, and especially like in the first day, like a lot of tax softwares won't even pull in for like 4-6 hours after launch because there's so much fluctuation in the first hours, or there's just not a lot of depth of liquidity. So like, what is the fair market value if we've got a very small subset of transactions? So we'll kind of defer to what the basically CoinMarketCap, CoinGecko will state and say, yep, if there's a value that's like fairly reasonable, that's income. I know we were talking off beforehand about Hyperliquid before we started this stream today. But in the case of Hyperliquid, that was an interesting one where it was actually like dropped out to people's wallets, and then they launched liquidity after the fact. So if there's not liquidity, there can't be a price because there's not a marketplace for it. So it actually was made available to folks before it was actually taxable. So depending on the mechanics of the airdrop, whether it's claimed, whether it's just automatically dropped before there's liquidity or secondary sales or anything of that sort, really affects what that taxable event is. But we typically defer to when it's actually claimed or received as that income generated event. At what value? To be determined.
Yeah, and then if you were able to claim this when it had no value, and then you eventually sell that asset, then how are we looking at that asset?
Then in that case, we're just looking at 100% capital gains, right? So this is also very common for folks that are contributing to projects. They may get a token grant, vested token units, token options as far as their efforts contributing to a DAO or project. They'll file what's considered an 83B election, which goes, hey, I'm getting granted these mythical internet monies here before there's even a chains launched or there's even a TGE of any sort, so a token generation event. So we can go, cool, I'm getting $100,000 of magic internet money that the evaluators are saying is nothing. I declare that as income, and then when it actually unlocks and I get it, I'm not recognized as a taxable event because I've already declared it. I've already said it's mine. And then we're looking at pure, capital gains treatment, or if it's been held up for a year, long-term capital gains. So the 83B is a huge tool when you're, actually providing services in relation for crypto. But the same thing applies to, receiving airdrops, payment, in tokens where there's no liquidity, no price, or the market hasn't been made yet. We're going to recognize that as $0 of income and then pure capital gains.
Cameron, I think I know the answer, but I'll ask it anyway. In your example, or your like the $100 bill on the table, and whether or not you're picking it up or you're just leaving it out there. What if you go walk out on the street and you take a little $100 bill and you shove it in someone's pocket, and they didn't ask for it, and they may not even know it's there, but they're walking around with $100 in their pocket?
That's a great, dusting, potentially different. So in that case, we viewed it on a case-by-case basis for our clients. So in the case of like someone just gets dusted some random coins, worth something, then yeah, like we might treat as income. But by default, though, if you haven't used it, you haven't interacted with the contract, you haven't traded it, you actually haven't like derived the full value, it could be the argument that it is not taxable. Someone just shoves some money into your pocket, so to speak. It depends on what you do with that money after you get it. If you just sit there and let it wilt and rot away, then yeah, probably not taxable. But if you actually take it and use it, most likely income.
Adrienne, this could be Jesse's next base video, where he just goes
right,
shoving into people's pockets.
Are you going chain?
Yeah. Is there any difference if you've like done any work? So crypto is just like such a wild space. So like what kind of work you did, like in DGen, your airdrop was based on getting tipped because you had good social content, right? But sometimes you were literally getting airdropped because you're holding some other asset. Is there any sort of difference whether you did work to receive this or not?
Not really. It's gonna be income regardless. It's just a matter of like what you got to get it. Like, could it be, if it's in a business, is it part of like your actual blood, sweat, and efforts? And then we're talking about payroll tax considerations. But if you receive something, it's gonna be income. Whether it's someone hands you a gold bar, someone hands you a car, or crypto, like whatever that be. If you've received something, most likely income, unless it's a gift. But no one's out here just gifting out of the goodness of their, I mean, in certain projects, sure, but no one's just gifting for the goodness of their hearts.
Yeah.
A little bit of lore. Kecker's got a car on Farcaster.
Oh, really?
Good point. Yeah.
Actually, it wasn't a car, but enough money to get a car, and she then had to deal with the whole gift implication. And
yeah, I mean, when some people are gifted a noun, and it's sort of, in fact, I think we talked about this last year, but it's kind of the same thing. You have to handle, and people are in their own jurisdictions and have their own things, but they have to figure out the value of it, and yeah, you just got it.
What's the floor? What's the attributes? Yeah, because essentially, and it's weird. I mean, for everything, when we're swapping exchange, it's pretty easy because we can just like point to whatever random oracles CoinGecko says. But when we're gifting, it may require like evaluation or appraisal. So anything over $500 or $5,000, if you donate it, like requires an appraisal. Even though it's like, hey, I know the price of Bitcoin pretty easily, I can point to it. It still needs a rubber stamp saying yes, it is the price of that day by an affirmed appraiser. So that's something to kind of think about. But for income, we're pretty easy in that world because we just recognize it.
Can I just take one pause and say, like, with a more crypto-friendly federal government, including IRS, do you think they'll make good, like, there are so many details in here. Are you confident that we will create good laws and reporting structures over the next 2 to 4 years?
I feel like, administrative policy is going to be more of a laissez-faire attitude. So just reductions, reducing clarity, and trying to like incentivize, basically American made. It's very much like America first overall. So as far as like encouraging, so like there was a domestic production activities credit, DPAD, that we lost back in 2017. That kind of like was incentivizing businesses producing, manufacturing onshore, kind of like R&D, but for hard businesses. I see also like potential rates reductions at the corporate level, individual level, even just different classifications for certain assets. There's also been signaling, for anything like launched, developed onshore, like the Made in America stamp could be essentially exempt or reduce tax rates across the board. So I am overall optimistic. But do you think will we see clarity as far as like what is this random Uniswap V3 vault? Like, is this taxable
Totally.
here or there? Like, most likely when we get through a revenue or like an examination within a revenue agent. But I don't think tax policy is gonna be focused on transactional. It's gonna let the courts decide that we figure out how the heck to view these things, which is unfortunate to the taxpayer. Even the tax practitioners are trying to like muddy through. But overall, though, I see like a more like onshoring of these types of activities, trying to claim revenue, trying to adopt it and bring it into the American system. But as far as like how we treat like staking, it's going to be argued in courts.
Noted. That's yeah. I can imagine these laws with these words like airdrop and staking in there. I mean, eventually we'll get there, I guess.
Yeah, well, it was something too that there was a pretty good thought leader out there, Jason Schwartz at Freed Frank. He's like cryptotaxguy.eth. He was talking about even just the definition of a wallet. Like the treasury was confused because like on Twitter, people use wallet as like, is it like my wallet address? Is it the actual seed? Is it like front ends? Like I can also have a hot and a cold wallet in my MetaMask and my Robbie. Like, is that the same? And by this confusion of the term of what is a wallet, like the treasury adopted it, which then makes ambiguity of how we implement this rule. So I don't think the IRS and Treasury quite. I mean, they obviously understand to the degree what it is, but when we're talking, we're in various radium pools. We're doing stuff on Jito or anything else out there. It's a bit further down. What is Morpho, right? Like I don't expect the average revenue officer to understand what the heck Morpho is.
Yeah, noted.
Theoretically, but actually no.
Yeah, totally. I think like I'm bullish on the way you just described the thing, right? So it's like someone's actually just going to need to tell them how our industry is interpreting it at some point, right? And really teach all of this stuff. You mentioned staking, so going back into the hard stuff, and there was a token dropped yesterday. VVV was airdropped on people, and then you can immediately stake it, and then by staking it, I don't know all the rules, but one of them was by staking it, you got emissions at like 1,000% APY. And so just generally, like, how do I think about staking, and then just sort of the emissions I get from staking?
So this is something that's also confused the IRS for the better. And I wear like, here's my like crypto CPA hat. We'll take it off in a second. So like CPA, fiduciary, obviously someone that understands the IRC is that the IRS back in 2023 said that staking is taxable. So you receive the tokens, it's taxable, right? Now there was a conversation we had, now taking this hat off and like thinking about this more theoretical. So myself, Fenwick, a few other tax lawyers out there, Freed Frank, Jason Schwartz, view that, at least native staking. So we're staking with, Solana, we have our beacon chain rewards. We're, actually participating as a validator or delegated staking. There could be the argument that this is newly created property, just the machinations of the block going like this, and I'm just getting a cut every single time this newly created property. Much analogous to like, the bamboo grows, I cut the bamboo, it just keeps kind of coming out of this initial thing, but it's not like coming from anybody. That differs in the case of like Venice AI with the VVV token is that there's a counterparty. The protocol, the project, somebody sent you some tokens, which means that is taxable to you and also deductible or an expense to them. So because there's a relationship, much like bank pays you interest, you receive interest, that's taxable. And then we typically view protocol staking, lending, yield farming, et cetera, as taxable in that case. Now, whether you actually receive the rewards, like that's a taxable event, or if it's auto compounded within the smart contract or A token, B token, whatever the version of that is, in that case, until you actually liquidate it, then your taxable gain event hits. So it depends on how the staking mechanism is designed from the protocol or project level. But but by default, like most likely taxable. In the case of native staking, delegated staking, you're a validator, it's a discussion.
Yeah, got it. If I think something maybe easier to think about is if I just buy a meme coin and I 10x it and I sell it, we're talking about capital gains tax fully there.
Yep,
and if you're you've done your own taxes every year and you've never filed capital gains, what is that like? Is there just like essentially a separate form? The calculation's straightforward.
So if you're trading crypto, I mean, like for more like novice or amateur investors, like you can use like Coinly, CoinTracker, Awaken, Crypto Tax Calculator. Really just pick your poison as far as the tool. It runs it through. It will generate, after reconciling a bit or clean up a little bit, what's considered a Form 8949. So that's the detailed list of all your capital gains transactions the past year. That feeds up into Schedule D, which is your summary from both that as well as anything from partnerships, downstream, etc. And that flows back into your 1040. The same applies for corporations, partnerships, the capital gains report on your personal or corporate income tax return.
Great. Yeah, I like, I'm not sure I would file my own capital gains. I guess now, I guess with this crypto software, like it makes it, a certain level of training makes it a viable thing to do.
Yeah, and thankfully, like swaps and purchases, like most tax softwares grab pretty easily because they go one asset in, one asset out, pretty easy. It's when you start to like interact on chains. So if you're locking up an LP, you're staking that LP, you're then restaking the LP, you're transferring, you're bridging. Like that's where softwares can come into issue, depending upon what tokens you're transferring, what you receive on the other chain or other network, or just in the case of just regular DeFi's, it's just protocols that aren't supported by various chains. So we've had a lot of fun with Pump.Fun the past few months. We're trying to and then people are staking it on various Radium pools. Like, are the Radium pools recognized? And then they're receiving emissions. So that's been a joy. But if you're just like buying and selling a Coinbase account, you're doing some swaps to your MetaMask or Robbie wallet, you're not going to be any worse for wear.
Noted. Yeah, wild. What's my follow-up question here? I really have a question about tokens, but let me couch this in NFTs, which in a sense are just tokens also. But you always hear towards the end of the year, people are like trying to sell their NFTs at a loss and they're tax harvesting. And so I guess my first question is like, what is tax harvesting and what are people doing when they do that? My second question is there an ERC-20 version of this?
Yeah. So what is tax loss harvesting? So first and foremost, because cryptocurrency is property, it's not a security, we get to have fun special tax treatment, which means wash sale rules do not apply. So something the previous administration was talking about of like this crypto tax loophole, this was it, is that you could theoretically like sell your ETH, wash it, recognize the loss, and the next block, pick it back up, reset your basis and go forward. Because cryptocurrency is property, you can do this without really any issue. So, periodically, like market swings, I'll personally do this. I'll just reset my positions, or at year end, you're looking at your portfolio, you're trying to burn, lose, trade, basically to recognize these paper losses. Because in the upswing, when you're going from token to token, you're receiving rewards, you're generating a lot of like paper income or paper capital gains that you wish you had this for. So just the very nature of interacting on chain, like simple as like, hey, I've got some WETH. I want to take that WETH and open up a WBTC WETH pool. I've got to swap part of my WETH into rep Bitcoin, recognize a capital gains event just to open up that LP position. So that's something that does happen. On the flip side, we want to make sure we're recognizing more losses to offset those phantom gains, although you're opening up. So that's something that's important to do on a periodic basis. And in the case of like NFTs and all it takes, if you've got some worthless ones, send it to a null address, so 0x000000, and get off your wallet. It just needs to be outside your control and realized. It can't just be sitting there and saying, I'm going to take a loss on this random like worthless NFT, meme coin, etc. It's got to be actual traded, swapped, or burnt.
And your loss that you're taking on that is the price you paid, basically minus zero. I mean, like,
exactly,
or 100%. And then does that work the same with tokens?
All the same. So fungibles, non-fungibles. Heck, if you buy like various degrees of gold at certain prices, like it's property, so we are allowed to loss harvest our property.
And so then the key is you just need to get that ERC-20 out of your wallet before you claim it.
Exactly. And I've had some people run it by me like, yo, okay, just send to my friend and like trade back and forth. And it's like arm's length. Like it has to be like you don't know each other in the streets. There are like platforms out there where it's like coming in front of mine, but like where you can just like send your NFT to them. They recognize the loss for you and it's out of your control. It's been essentially converted. But yeah, you can't just sit there. You can't sell it to your mom. It's got to be at arm's length.
So TLDR, if you wind up at a net profit of $0 with your meme coin trading throughout the year, there you kind of, I mean, I'm sure there are details here, but for the most part, you don't owe any taxes because you didn't make any money. Even though it's like I 10x'd on Trump and then I lost them all on Melania, then you're basically at zero, right?
Yeah, exactly. And it's something where I mean, there's a joke amongst tax professionals, it's a very good joke, but like meme coins, NFTs are great for loss harvesting because like 97, 98, go down, which means they're ripe to actually sell and liquidate. So it's for the project, for the memes, right? But apart from that, though, yeah, it's most people end up either break even or in a net loss position on those.
Yeah, cool. That makes me think about my meme coins a little bit differently. I've never tax harvested my meme coin. I'm not a huge meme coin trader. Actually, this year I started more towards the end of last year. So maybe that's something for me to think about this year more.
There's no judgment. No judgment.
Yeah, yeah. We love the memes. Adrienne launched a meme yesterday on a live stream. We're here for it. What about yeah? I don't think I have this in my questions, but now that I'm thinking about it, it's like, let's talk about, there's actually two different ways I want to talk about LPing. The first one is like maybe most specifically related to Clanker, although I think this is going to be a highly adopted model. So when you launch a meme coin through Clanker, you receive a percentage, as the creator, you receive a percentage of the LP fees. So, like, what do I think about the LP fees? And is it different than if I'm just making an LP position? Is it different than like I just have $1,000 in OI and so I just LP it on Uniswap?
Yeah, no, totally different. So the actual like emissions or fees you're receiving from those LPs, those are taxable as income. Just like if you were minting off NFTs, if you're receiving like commissions or royalties from subsequent sales, you're getting paid a commission of that, like it's taxable as income. Now, in the case of LPs, go ahead, Adrienne.
Can you define emissions? So I don't know what it is. And I heard, Chris, I know you brought it up. I kind of assumed in relative to staking, I assumed it was some sort of yield, like some sort of like the way I think of yield and rewards.
It's yield.
But
yeah.
Okay.
It's yield, emissions, income, commission, kind of interchangeably, but essentially what you're earning for either providing liquidity, providing tokens, or providing services, I would say is emissions.
And it's and the analogy is because we use gas as like what your fee going in and your emissions coming out, because we have to stick with that analogy. Is that what it came from?
I didn't create the lingo, but I'll go with it.
Yeah. To me, it's just like there's somehow this asset that's just emitting more of the asset.
It's just emission. Yeah.
Got it. All right. Yield
I like to think of it as like the actual like fracking of all the emissions coming out of the fracking. That's what I think about is the actual events itself. So
I wonder how many of these words we all have different mental models of. But like, maybe it's like worth even just talking about LPing, right, which is liquidity providing. And so if I want to be a liquidity provider, again, there are 1,000 different ways to do this with nuances, but the basic is that like I want to provide liquidity for a non-token for people who want to buy it with ETH. And so I put up $1,000 worth of ETH and $1,000 worth of a non, and it's put into a liquidity pool. And then as people are buying and selling that token, a very reductionist way, they're buying and selling it from me. And so when you're LPing, you see like your shift, like, oh, now I have a bunch of ETH. Oh, now I have more non. It goes back and forth.
Yeah.
Okay, cool. And
this is fun. So it depends. It depends. But let's go into
it. And then there are two options. You just let it keep. I mean, there's so many options, right? They're just from the Uniswap basic interface. I can claim it, or I can just leave it there, or I can use a tool like Revert.finance that constantly grabs the reward and puts it back in and reinvests it. So.
Yeah, so I would say, so in the case of LPs, this gets fun, is, by default, I got to think about this, like what's happening on chain, right? So if I have this WETH and USDC, I am then depositing the liquidity pool and then receiving an LP token return. Now, that could be viewed as an exchange of like, I'm taking like, my WETH and my USDC, I'm getting 50% of the LP token, 50% of the LP token for it, and that's a taxable event because I'm exchanging those two assets for the LP, which is a representation or share or interest in that pool, which is kind of a batch of all these various tokens. And then when I leave the LP, I get those assets back. I recognize a capital gain or loss on my LP when it's been opened, and then I get those back at the fair market value at the time of receipt. That's what most softwares will default to. I do know that within coin tracking as well as in crypto tax calculator, there's the option to kind of like know and treat LPs as non-taxable. And kind of the theory behind that is like, I also can see this. I mean, it's how I view my own portfolio, but do your own research, is that I view it as like, if I'm contributing both these into a pool, I still have a representation of 50% of these assets, and I'm getting these back. And then whatever I get back, the delta between what I originally contributed is that capital gains event. So I'm still getting back the same equivalent amount of WETH or USDC minus a change for whatever happened within that pool. That's something that is subject to interpretation, discussion, certainly examination at a later point in time, but certainly both arguments we have, but the more conservative would be to treat those as taxable upon entry and taxable upon exit. And then with the emissions, if there's like an auto compounder mechanism to it where the rewards get received, they get bought back, swapped into 50%, 50% redeposit back in the pool. If it's something that's kind of outside your control through a bot where it's not really living within your wallet, you're not manually push the button, I could see that's not taxable as like an auto compounding mechanism. But that's why we see, like in the case of like staking, we've got liquid staking tokens, right? That automatically do this for us. They take the rewards, put it back into the token, which increase the overall value in the position. But I can say I didn't touch anything, I didn't receive any of the rewards. So the flip side is like if I receive them, I deposit them back into the LP pool, like potentially taxable because I've had the dominion. I received them. I could have sent them out of the wallet. I could have withdrawn them. I could have exchanged them. I just chose them back in the LP. So to be determined, but I've, with clients, depending upon the risk preference, as far as like the overall pool, we've taken both approaches.
Do you see new DeFi primitives and techniques every year when you have to do this? Like literally every year, you see something new happen?
Every year. I mean, you can. It's only so many different ways to do a CDP or a vault or like a liquidity pool to a degree. But we're seeing now more and more is like, isolated ecosystems like prop chains, or like Hyperliquid or like DYDX, where like they have their own ecosystem, their own activities, their own trades that exist outside of the typical EVM Etherscan ecosystem, where you can kind of plug into and see what the hell is going on. So that's happening more and more. That's the more like common approach these days. But as far as like changing what the heck we're investing on chain, there hasn't been too much craziness apart from the existing model set up back in 21, 22.
I was going to ask you what was new this year, but I mean, you just talked about Hyperliquid as one of them.
Hyperliquid was big, yep. And then meme coins went crazy, and we're kind of chasing just like new protocols or new ways. Like functionally, the same transactions are there, like swapping, bridging, LPing, wrapping, vaulting, staking, etc. It's just a matter of like who's doing it now, and do our tax software support it?
I am something that is actually don't know if I knew this, but it's something that I have been nerd sniped about recently, is just morpho lending and morpho pools. And I don't even know if I would be the best one to describe what a morpho pool is. I could try, but I would prefer someone else would try. But just wondering, like, are those treated any different than any other asset?
Yeah, I mean, we typically treat like vaults as long as it's like a single asset vault, so 1-to-1, like a WETH vault, and like some sort of like Pendle was great about this for yield, where they had various different degrees, but like, you're just still contributing like WETH or ETH into it, or whatever the native asset is. So in that case, we typically view it as a non-taxable entry, and then certainly the rewards you're earning are taxable, but the actual swapping from your WETH into like a Pendle version, a Morpho version of WETH, and earning those yields, not taxable. It's kind of the same thing with like take a dive back with more boomer DeFi with Aave with A tokens. Is like you've got WETH, and now you have like AW WETH, which is essentially the same thing. It just allows you to earn interest. They are different different tokens, different addresses on chain, and therefore could be argued there's a swap, but they're functionally the same. Just one allows you to earn interest. Just like if you deposit your USD in Chase, you now got Chase USD, but that allows you to earn interest in return. That's kind of the same methodology we view it.
Awesome. Adrienne, I see on our doc here, you added a question. Do you want me to ask that question?
I added a question on our doc?
Wait. Oh, well, okay. Let me ask the question then.
Not me.
If it wasn't you. Okay, cool.
I added questions. I have questions on my private notebook right here on my desktop as we're talking. I added a question, but I'm like, you don't see that, Chris.
Oh, I see. Christina has questions about Eric.
Or does he?
Yeah.
Yeah.
Yeah, I guess this is actually a good time to ask this question, because it is somewhat a continuation of that discussion, which is like, what if you're buying or selling NFTs that are staking positions? Like you might buy, just an NFT that maybe you buy the NFT that represents a liquidity pool.
Yeah, and that kind of goes back with the positional NFTs, with Uniswap V3, where you're actually like, you're not just like an LP token return, but actually a representational NFT, like each position its own lot. And that's one where we typically seen as like a little bit harder case to argue. Like back when Uniswap V2, like you'd actually see both assets go out and go into the LP. then you get this LP token in return that was a representation, or like your redemption where you could say, hey, I'm going to burn this and I get my tokens back. Now, in the case of these NFTs, it's kind of the same methodology, but it could be argued that you are swapping both these for the NFT. And like I said before, the NFT appreciates, depreciates with the underlying basket within it that supports it. And then you recognize a capital gain or loss upon that NFT position. So we've kind of leaned on the more conservative treatment as of recent, but for certain clients, certain cases, open to that discussion.
Yeah, my overall take is that certainly your approach, but the approach is like it's pretty consistent, which is like you've either you're recognizing revenue, or you made an investment and you're looking at some sort of capital gains event. And there's some nuances, like if you put money into your LP, are you paying taxes on splitting the assets? But it overall seems like, there's two categories of things that crypto, and you describe it all in a very common sense way that I think like people could think through how to do some of these assets.
No, it's basically ordinary income and capital gains covers everything. It's just a matter of like when we're recognizing it, and something that is an inner north of our firm. Myself is like, I understand that like, yes, the current tax code recognizes like property to property, so fungible for fungible, asset for asset is taxable. Like going from like WETH to AVE is a taxable event, but like I've got a wife and 3 kids, like that AVE can't buy diapers, right? So like, although it is you're accreting value, it's like that value can't be turned around and spent. It's got to be, it can be invested, it can be deployed, it can be wrapped, it can be earned, but like you're not actually getting concrete value that can be put here in the overall tangible space. So there are certain, things where I can certainly understand it, but like the current tax code of how they view it is almost detrimental in certain aspects, which I think it's also great now that we're even seeing from the SEC level of like allowing potentially in-kind redemptions for the ETFs of like, I can actually own Bitcoin if I want the ETF, have it custodied, which is again against the ethos of a permissionless ecosystem or the economy. But in that case, if I want to have custody, I can give my BTC to them and not recognize a capital event. So that's something I think is kind of getting there, but we're still in this weird, like, who knows, shifting sands. Is the IRS going to be more enforcement? Are they not? Are they still clueless? In general, though, what we're seeing from the agency is a lot of focus on just like unreported transactions. That's easy. Like if you didn't check the box, they find out from Kraken, Coinbase you had sales, like they're going to pursue it. But I haven't seen yet from my clients yet, knock on wood, of any like examinations based upon the substance of transactions. Like, is staking taxable? Is this LP taxable? Is my AVE earnings, are that swap in there taxable or not? So it's mostly focused on non-compliance, which they've got plenty of their work cut out for them, rather than focus on the more technical transactional issues. But things could change as minus the news of taking those 88 enforcement agents and putting them at the border, which we'll see how that goes. But the IRS is going to be a bit understaffed here going forward, unfortunately.
I don't think that's true.
So, Cam, can I ask a question? In your experience, so in that example, so let's say I'm someone who did make a good faith attempt to pay my crypto taxes, and I missed something, and IRS picks it up, they flag it. What is the worst case scenario? Is it they're coming at me and I'm paying with interest? Like, is it a fine? Is it just something I kind of pay with interest? Is there criminal charges? Am I in jail?
Yeah, jail
and
automatically. Go. No.
Is it like a nice jail? Is it high?
Yeah, it's a it's Scandinavian jail, not Latin American jail. No. Jokes aside, is there are 2 different ways of understatements or underreporting. So there is a significant misstate or understatement, which is 25% of your income, and then everything else below that. So in the case of a significant misstatement, the statute of limitations is 6 years, which means the IRS has 6 years to figure out how much you underpaid, declare it, issue the report, and go find it, or actually start the examination. So if you back in 2021 you forgot to declare $1,000 airdrop, we don't care. It's unless $1,000 was 25% of your $4,000 of income, then yeah, we probably care. But in that case, you're small underneath the radar.
Even still, they're probably not caring, right? Like if you're declaring 4,000 of income.
Exactly. So I'd say for most, there was a statistic, I think it was 21 or 22, that like only 2 million or so like taxpayers check the box that they acquired crypto, but like a Coinbase report was like 35 or 40 million. So there's a huge gap of like people just running with it and just going for good luck as opposed to actually doing compliance. So the very fact we're here having a conversation, you may be filing inclusive crypto data, puts a lot of people ahead of most people. Not saying that like that's good enough. Like, you should be better than good. Obviously, people working in the space. But not, I wouldn't sweat, hey, I actually misclassified this, or hey, this was missing here, unless it's a known misstatement. And as far as like penalization, like, hey, you may have missed a wallet, it was just imported correctly, they had a finding, typically it's going to be just assess the tax, maybe penalties, maybe interest, just depends upon the nature. Like, if you just willingly and negligently didn't include it, you're going to get hit with penalties and interest, potential criminal penalties. If it was like, hey, I didn't know, the tools weren't there, I was on Tezos back in 2019, no one can really fault you in that case. So it depends on your best effort and good faith, which, although the agency is this like mythical bureaucratic organization, every single revenue officer is a human. So trying to understand, explain the narrative, how we got to that point, really, really helps in any sort of case. With that being said, though, there's been a lot of chatter about 6173 letters. So we had a client's friend receive this, which is basically the IRS is saying, hey, we think you may have unreported transactions. It's not a finding. It's not an examination. It's not an audit. It's just kind of like a, hey, let us know to get ahead of it. But there was a couple other thought leaders, Clinton Donnelly, as well as Andrew Gordon out there, tax attorneys, were saying, like, do not sign and send this in because it opens you up to examination. Whereas if you just don't respond to it, you're not saying, it's kind of like plead to the fifth. It's like, I'm not saying or not, like, basically do your own dirty work. I'm not going to prove that for you.
Putting the burden of proof on the IRS.
Exactly. And given that they're understaffed and whatnot, that's a lot of burden. So unless there's a known misstatement, that you should probably get taken care of and get ahead of it before there actually is an issue. But
yeah,
for most people, go ahead.
Should people assume the IRS has mappings of social security numbers, like, and addresses, even if not guaranteed and not accurate? Like, do you suspect that the IRS, or that's kind of known?
I suspect that they have something. What they do have, though, is certainly exchange data. So any, like, even though data isn't mandatory here until 2025 and 2026 for brokers and exchanges here onshore, through findings, through hacks, etc., or through their work previously, like, we've had clients like had their data from Kraken or Coinbase reported to the IRS, or they're aware of it through some. I think it was with the SEC's investigation they did. They were able to obtain this kind of data, so there has been some findings. But as far as like doing analytics, I would say potentially if they see something's there, they may do some tracing. I've also seen like Canada's CRA actually start to attribute income and do finding and saying, hey, we think these addresses are likely associated with your accounts. Prove these aren't yours. And that's unfair, very aggressive, but that's not to say that things could change. But I also think the regulatory climate is different with the US's IRS versus the CRA, even the UK's HMRC, the Australia's ATO. So I don't want to see that, but if someone's coming down with the examination, they're probably going to deploy the full tools of it to figure out what the hell they actually owe. So
gotcha. And those
chain analysis does exist, but I wouldn't say like a broad, like everyone's getting surveyed, because it's a lot of resources, a lot of analytics. And we're doing this as like experienced professionals. We still sometimes can't make sense of client portfolios. So I can only imagine what the hell is going on at the IRS's level sometimes.
Yeah. And those acronyms you just said are the tax agencies for Canada and the
Correct.
UK, respectively.
Exactly. Yep.
Thanks.
It's so funny. I just literally received my 1099 for my work with Hacks Protocol. But interesting, they pay me in a pre-token, which probably has no value. Anyway, that's just a serendipity that notification popped up here. I wanted to ask anyone watching if they have particular questions. We're getting pretty close to wrap. And while I give people a minute to type that in, Cameron, while we're just still talking about the IRS, I'm wondering if you met someone who, if any of your clients have ever been investigated, where you've spoken to IRS or agent where they seem to know what's happening around.
Yeah, most recently at Consensus, I spoke with a couple of the IRS CI, so criminal enforcement's their criminal enforcement arm, and again, a lot of their stuff is just focused on bad actors, non-compliance, people that just like substantially understate. So like, what was it, the Bitcoin Kinger guy that like fled and was for tax evasion, Brexit tax? Like, they're focused on more notable cases, people that are flaunting that, hey, they launch a meme coin, go out and buy a Ferrari. Like, yeah, you're probably gonna get audited because they're also not preparing their taxes correctly in the first place. But as far as like, just pursuing individuals to be punitive, I don't see that. Even the Tezos case with staking was brought upon by the Jarretts themselves. A lot of it's just, like I said, on enforcement actions, people that did not report, that likely have income, And it's something I like to, say in jest sometimes. It's like, it wasn't the fact that, Capone was, selling alcohol legally during bootlegging during Prohibition. He could sell, he just needs to pay his dues. So the IRS is kind of like amoral in that regard. So if you're earning something, doesn't matter the fashion, the form, they want to earn their due. And if you're not reporting it, they're going to want their share. So, but overall, though, I don't see it as like a very like toothy agency. I think, from what I was talking with them at Consensus this past May, is more just kind of like seeing where the SEC, the CFTC, like what the heck do we treat these things at the federal level, which will then enforce us to like, hey, how do we treat them? How do we calculate them? And start to go in the more transactional nature. But if you're buying and swapping, don't report it, you're going to have a, potentially maybe an unfortunate call or notice down the road.
Ironically, all we all want is some sort of clear policy that we understand and know
Trust
the
me.
rules,
Oh no, and it's something like, it'd make my job so much easier because we're playing like crystal ball, reading the tea leaves. Hey, for this random DApp or protocol on Base or Bearer or whatever, like we should treat it this way. And we're looking very much like not seeing the forest of the tree sometimes because we have to in certain cases. And truthfully, having like sensible like code and not something from the 1980s. That was the most recent refresh, the Internal Revenue Code, minus bills and stuff through Congress the past 40 odd years. I would greatly appreciate it so we can actually like be more proactive, inform our clients, and start taking positions. Just like we know how houses are treated, we know what it's like to treat a businesses, selling, liquidating shares, income, etc. But like when it comes to these transactions, here's guidance, here's FAQs, which at the end of the day aren't really binding the taxpayer or practitioner. It's binding to the IRS if they see these on a return. So there's certain like FAQs and guidance that are certainly like a little more like sticky, and there's other ones where like, yeah, you're chancing it. Like, good luck trying to prove that in court, but prove it against the IRS tax courts.
I'll wrap this up with there's some chatter in the chat about DAOs. And so maybe even from a basic level, I'm a member of a DAO. There are 5,000 of us. The DAO receives revenue because maybe it gets a big grant from someone like Optimism. Who has the tax liability? Now, let's imagine the DAO has no legal structure at all. And then a second level where maybe it is a DUMA or an LLC or something like that.
Yeah. Always wrap it, which is good in the case of a DAO. So having some sort of physical wrapper to exist, whether it's a foundation, a corp, onshore, offshore, but at least we have something to work with. Because if not, and we have a DAO, we have an association, which an association by default with US members, just like someone here at the Nounish Professor said, is a general partnership, which not only means unlimited liability, but also taxable income, even if you're not touching it, for each individual partner themselves. So having some sort of vehicle to wrap the DAO, whether it's a corp, whether it's an UNA, whether we're actually having some sort of vehicle to say this exists outside of myself as a person, as a collection, because an association can be an UNA, which is an unincorporated nonprofit association. We've come across, HairDAO was one of this until they finally got recognized. And a few other clients, they come together, they receive a grant, they want to deploy said grant. But until you receive permission from the IRS to act as a nonprofit, you're for profit, and a for-profit UNA is an association, which is taxable as a partnership. So it is very, at least, again, materiality speaking, you're getting a grant from, Nouns, ENS, Gitcoin for 15 grand, you go and deploy it, pay yourselves, great. Probably not worth kind of fretting about, but if you're getting, $100,000 retro grant, 250 grand, now you have a treasury to manage, there's more liability, more risk, you're going to want to have some sort of wrapper for that vehicle.
All right, awesome. I think we can, let's just wrap it there. I appreciate your, wrap your DAO, people. Wrap it up. I appreciate this chat this year. I appreciated it last year. I hope we get to do it again next year. Thank you to GM Farcaster for hosting us. Thank you, Adrienne, Prof in the chat. Any last words, Adrienne or Cameron?
Great.
I know where can people find you, Cameron? That's the most important thing here.
Yeah. So I'm on Twitter, 0x on Farcaster as 0Argos as Wanako, which is my favorite camel in South America. And then our website for crypto, or for our firm, is www.Darien, DARIEN, advisors.io.
And if someone wants to retain your services, what's the best way for them to contact you?
Yeah, best way is just to holler. We've got a form, so just book some time with us on our calendar. myself or our sales ops guy will be happy to meet with you. You can also reach out to me on Twitter, my DMs. I also forgot Telegram, which is Cameron_CPA. I welcome any and all questions when it comes to tax. So please inundate me. It's something that's very important. And as I say, there's nothing life uncertain but death and taxes. So hoping to make life a little bit less stress for you.
So awesome. I love how crypto native you are. You have 1,000 different ways to get contacted.
Yeah,
this
right.
was really, yeah. And just shout out Bar Lucid and Christina who brought us together. I'm excited to see where this conversation is in a year from now. Cameron, clearly an expert. I can tell how much you love to talk about crypto and taxes. So we really appreciate it. Christina had one more question, and if there's time to answer it, because she is the reason we're here today, if you have a few more minutes, she was curious if it matters if I launch a token with Clanker, if you know what that is, versus something that you actually designed the incentives and did a fair launch or airdrop.
Nope. Same methodology applies. So if you're receiving incentives, if you're launching the token, anything you retain or whatnot would be potentially income or capital gains tax. But if you're launching your own protocol, DevCo, and then launch the token, or using a third-party platform to do so, same methodologies apply.
That's it, people.
Right.
Launch your tokens and pay your taxes. And
Not a topic. Yeah, not a topic anyone wants to talk about. But
listen, the important thing is when your bag goes to zero, burn it and recognize your loss.
Exactly. Tax evasion, illegal. Tax minimization, tax avoidance, very much legal. So let's stay on the legal side of things.
All right. Thanks again. Thank you both. And thanks everyone who showed up here for this.
All right.
Cheers. Thanks all.
Cheers.
Catch you guys later.